adjust the microphone settings. So let me know if you can hear me and you could see my chart as well. Doing a quick sound check. Testing 1, 2, 3. All right, Steve. Thank you. Solomon, Brian, Cliff, Dave, David, Jerry, Joe. All right, very good. So a few things here before we begin. Remember that trading is risky. Please don't trade with funds you cannot afford to lose. Understand the risks involved with trading and talk to your broker. So what we're looking at here and what we're going to do today, Friday, is look at the changes that have been occurring in the marketplace. And with the market slowing down a little bit, we have to understand that as well. So you know that I look at, and for those of you who are new to day trading, visit DayTradeToWin.com. We focus on price action trading, and we do offer something a little bit different than most vendors out there that we promote understanding of the courses, understanding of the methods. We don't like to use the typical indicator like a moving average. So those of you who are new to Day Trade to Win, take a look at our videos and daytradetowin.com for more information on the style and the type of trading like I'm going to do right now. So what we're going to do is look at the changes that have occurred in the market and how to adjust the way that we think about trading. Because if you use the same profit target and if you use the same stop strategy every single time you enter into a trade, you're missing a big part of it. And the big part of it is whether or not the market is slow or whether the market is fast or even if it's tradable. So sometimes the market is not tradable and you have to know that. It's not a good opportunity to trade. I'm going to stay out of the market. One of the things that I like to recommend is even though this signal here to go long here right as the market opened um, would have given you an opportunity to jump in right as the market opened to press that button long. The problem is typically right within the first 5-10 minutes, there's a huge amount of activity that is, I would say, more chaotic than the rest of the day. So I recommend not jumping in, even though this trade was a good trade here to go long. I don't recommend jumping in right as the market opens within the first 5-10 minutes, and I don't recommend the last 20 minutes of day trading because there's a squeeze that occurs on day traders right as the market closes. A lot of traders are on margin, and what happens is the margin forces people out of the market. So there's a little bit of a chaotic environment that occurs the last 20 minutes of the trading day. So in looking at the type of conditions that exist, let me go here to a very simple 1 minute chart. And on a 1 minute chart here, you can see these candles moving up and down. And for those of you who don't know what you're looking at, this here is a wick of the candle, and this is the body of the candle. And what this indicates is that since it's a red candle, the market opened at the top of the body and closed at the lower half of the body. So the market opened here and closed here. But during this first minute of trading, you can see all the um, chaos that it occurred. You can see that even though the market opened at this price, which happens to be 33.3175, it went all the way down and then went all the way back up. So you can see how if you try to make heads or tails of this all within 1 minute, the market made a huge swing. This looks like about 4 or 5 points here. So there's a big swing in a short amount of time, and that's a problem. You can't trade under those conditions. And then the market continued here, and now here we are. Now let me explain here the signals that you're seeing. This happens to be the TradeScalper method, and the TradeScalper method can be traded on a variety of charts. The recommended chart is a 1 minute chart. It also works very well on a 2 range chart or a range chart. Some traders like 4 range chart, as we did last week. Some traders like a volume chart or a tick chart. But I'm going to keep it nice and simple. I'm just going to place the software on a 1 minute chart. Even though those of you who are using the TradeScalper probably adapt it to your own style, this is, I think, more of a universal idea. And with a 1 minute chart, I'm looking for an opportunity to buy or to sell. So when you see these signals here on the software here, it's very specific. The specific aspect of it is it provides a signal with a price. So the price is saying to go long at 32.50, and this is another signal to go long at 33.32.50. So we have two signals to go long. They're both created on different ideas, different reasonings behind going long. So this signal here to go long at 33.32.50, very similar to that range chart you saw earlier, tells me that I'm going to buy the market for a small target. Jason says here, do you typically avoid the first signal or so right as the market open? It's not the first signal, Jason, specifically. It's more so the time. When you look at um, the market as soon as it opens, it almost has a rush of traders jumping in, long, short. So when you're looking at this here, think about the idea behind scalping the market. It's a small target, it's a small stop. It's not a situation, as Jason is asking, avoiding the first signal. It's the chaos that happens. And if you have a very tight stop, as for example, as the market opens here, the first minute, if you have a very tight stop and you went long, you bought the market, you can see that it went all the way down and all the way back up. So you'd be, I think, in trouble getting taken out unnecessarily because of that volatility, because of that chaos. So it's really because of the time that you're trading within the first few minutes of the day that creates this acceleration of traders trying to get in as the bell rings. So it's not necessarily the first trade or signal, it's that time. So Jamie says here, do you make your trades based on the software or do you combine it with technical analysis? No, I don't use any specific technical analysis. And you could, right? There's nothing wrong with that. Let me just forward that to everybody. So if you have your own technical analysis, for example, prior support or resistance, or yesterday's high or low, or maybe some other indicator that you're using, unrelated to the TradeScalper software, that's fine. There's nothing wrong with that. But I personally don't use anything besides knowing when news events occur. If you want to look at prior resistance, like a high of a day or a double top or double bottom, yes, obviously, that may influence what you do because you can say there's a strong support. I need to see that support broken or that resistance broken before I decide to buy or sell. I don't think there's anything wrong with that, Jamie, or looking at other factors. But specifically, I say no. And the more complicated you make this, the harder it is. So my goal is for you to understand and learn a variety of methods as we teach in the mentorship class. We have the at the open, we have the atlas line, we have the roadmap, we have the blueprint, we have the X5, the trade scalper, the price action scalping method is a different type of scalping method. And so we have uh, all of these trades and methods that are unrelated. Nothing uses moving averages or MACDs or weighted moving averages. There's nothing, or EMAs, there's nothing at all, stochastics, momentum. I don't use any of that. I want to instead explain and show you an analysis of the market using price action only. And that does not mean candlestick interpretation. So if it's a shooting star and all that, I don't teach that. It's not relevant in my type of trading. So the idea behind going long here on this signal or another signal is first to know whether or not it's worth trading. I'll show you a 250 tick chart, Frank, no problem. Sure, give me a second, I'll show that to you. Happy to do so. So when you enter into a trade, at least understand the conditions that exist, okay? So the conditions that exist is, let me just add here something to the chart. I'm going to add a little indicator called the ATR, which is the average true range, and I like to use a setting of 4. And this helps me understand whether or not the target and the stop need to be adjusted, increased, if the market's too volatile, if the market's too slow as well, because we've seen a lot of activity, a lot of volatility recently, but it doesn't mean that the market can't slow down. So this here tells me what the conditions are at the moment, at the exact time to place a trade. What can I expect? So if you look here as an example, the ATR was at 2 points. So this is the current market conditions. That means my stop has to be based on this value. My target has to be based on this value. Everything that you're doing is now based on this value. And if we have another signal that occurs, for example, here, right here, I will look at this value, 2.5 points, to tell me what the stop relevance should be, what the target relevance should be. So it's constantly changing. And you can say that what's normal is between approximately 3 ticks, 1 point, and probably 2 or 3 points. That's normal. Anything below a point, I would say, becomes a little bit slower. You can still trade it, but usually within below a point, you can see a little bit more chop. So another understanding of looking at price action is, why is the market slow, or why is the market chopping, or why is the market not giving me my signals or my trades to make that profit target? And that's probably because the ATR is either too volatile or too slow. So Jason, in the past, it's a good question. Jason says here, in the past, when you're looking at a profit target for scalping, it's usually a point, right? But now I'm using the ATR. Well, I always use the ATR, Jason. I always look at the ATR to tell me what's happening, what exists. In the past, the ATR on a 1-minute chart was between 2 and 3 ticks, 1 point. That was what the normal was. If you go back in history, you can see the last before January, you can see that the ATR was always between 2 ticks and 4 ticks, which is, or maybe a point and a quarter. So between this area right here, you can only take 3 ticks or a point because that's the conditions. But since we've had this crazy volatility, we have to adapt. And by adapting, the signal there, 33.60, 33.36 quarter to go long. If everybody can see that, that's a long trade. And the ATR at this point is 2 points. Okay, so what I was referring to, Jason, was that in the past, if the market is normal, the conditions are 3 ticks, a point and a half. So my target's always going to be based off of that. There's not going to be too much of a variety when it comes to analyzing what to do. But when the market has exploded with this volatility, using such a small stop, 1 point, a point and a half, even 2 points, you're going to get taken out. These candles are so large that you have to adapt, and that's the reason why looking at the ATR, it gives me an understanding of whether I should even trade if the market is too volatile or too slow. All right, Jason, just wanted to bring that to your attention. So 33.36 quarter long, about, I would say, to be conservative, right? 6 ticks, 7 ticks of target, because that's really based off the conditions. And so if you don't know what the E-mini S&P works in quarter point increments, so every time it moves up or down, it's a quarter point. And I can show you that at the increments here by increasing. Let me just adjust this here like this. So the smallest increment that the market could move is a quarter tick. Okay, so each movement up or down is a quarter of a tick, 0.25. It's worth $12.50. So if you're looking at this here at 1.89 or 1.79, or if you're looking at this value, you're saying, well, what does that mean? What's the relationship? Well, 1.79, as you see here right now on this current candle, if I round down to the nearest quarter point, that would be 1.75. So in reality, 1.75 at the moment. So in terms of quarter point increments, that's 7 ticks. Now, if you look at the candle that had the signal, it was 2.18. Again, very simply round down to the nearest quarter point, right? Because there's not really a 2.18 increment. There's only 2 points, or 2.25 points, or 1.75 of a point. So I round down. So this would be 2 points. Now, as the market continues here, if you want to look at a target that is a little bit more conservative by a tick or 2 ticks, I don't think there's anything wrong with that. You want to be in and out of this sooner rather than later. So if the ATR is 2 points or 8 ticks, take 7 ticks. If the ATR right now is 1.66, again, round down to the nearest quarter point increment, which is 1.5, which is 6 ticks or a point and a half, same thing. 6 ticks or a point and a half. 1.5 is the same thing as saying 6 ticks. And this is just things that you will start learning, as you look at these numbers more and these values. They're pretty universal. Other markets work in tenths, not in quarter points. Like the E-mini, the Nasdaq is a quarter point, as well as is the currencies like the euro. Some currencies are in tenths, like the Canadian dollar is in tenths. So this isn't something that you should be too concerned with. As long as you stick with one or two markets, it becomes very easy to learn and to memorize these values. So a point and a half is 6 ticks. 0.75 is 7 ticks. 2 points is 8 ticks, right? So it's just a quarter point value that's incrementing up or down. And so at the time of this trade, the ATR was about 2.18. So that tells me that 2 points is what this trade can do. So 7 ticks, it should be a profit target. The stop should be a little bit larger than the ATR because you want to stay in this trade, because if I know the market could go up or down by 2 points, I don't want to have exactly a 2-point stop. I want to have a stop that's a little bit larger just to keep me in by a tick or two. So don't overcomplicate it. The ATR will guide you with the target and the stop always. Okay, so 33, 36 quarter with a potential of 7 ticks, 6 ticks to the upside, and the market moved 2.25 points. So it made that distance that I was expecting. So you always have to have a little bit of an expectation of what the market could do and not just have the same stop, the same target, and the same adaptation to every single trade. You have to understand what is happening at the moment so you can say, well, my stop should be larger, my stop should be smaller, my target should be larger, my target should be smaller. If you want to learn more about trading, visit DayTradeToWin.com. Subscribe to the DayTradeToWin YouTube channel, the next mentorship class where we cover all of these methods with lifetime licenses for the software